This is Jim Lineweaver with Lineweaver Wealth Advisors. On Wednesday, the Federal Reserve raised its benchmark interest rate by 75 basis points, which is the central bank's largest rate increase at a single meeting since 1994, according to CNBC. Fed Chairman Jay Powell communicated that they will most likely raise interest rates another 75 basis points in July, and they expect to raise the benchmark interest rate nearly another 1% before the end of the year. Stocks initially rose in response to the central bank's actions as investors welcomed their commitment to continuing to raise interest rates to soften inflation, which appears to be what the market's biggest concern is. However, after people have had the time to digest the news, today it was met with more recession concerns as the Fed had to increase more than the expected 50 basis points that they announced at their last meeting. So financial markets have been challenging this year. The Dow Jones Industrial Average and the S&P 500 Index appear to be on pace for their 10th weekly decline in the last 11 weeks. This has resulted in the S&P 500 Index declining more than 20% from its January highs, which is often recognized as the threshold of declines that define a bear market. The U.S. bond market, which is often relied on for diversification, is also off to a historically poor start to the year, down roughly 12%. According to the Business Insider, this is the first time stocks and bonds both experienced a decline of over 10% in 50 years. The most recent leg down in stocks occurred in response to May's Consumer Price Index, referred to as the CPI report. This was released last Friday on June 10th, which measures the rate of price increases across a broad set of goods and is commonly used as a measure of inflation. It rose 8.6%, which is the fastest pace since 1981, according to CNBC. Markets declined in response to the potential negative chain of events that may occur as a result of rampant inflation. The higher the inflation rate, the higher the Federal Reserve may have to raise interest rates, which means the more the U.S. economy could slow down. This increases the risk of a recession, which increases the risk of declining corporate profits, which is what stock prices really rely on. So at a time when news headlines and investors appear to be mainly focused on the negative outcomes, we observe some positive developments and their investment implications. May's 8.6% rise in inflation versus the same period 12 months ago was really driven by a continued rise in foods and energy prices. The supply has been mostly impacted by the conflict between Russia and Ukraine. These categories represent nearly 25% of the index that measures inflation. However, we believe that some early signs may be indicating that the inflation rate may peak sometime in 2022, but remain at elevated levels. So for example, the pace of change in used car prices has slowed. The advance in home prices is likely to cool off following the rise in the 30-year mortgage rate to over 6%. And lumber prices have come down 50% from their peak, and copper prices have declined nearly 20% from their March highs, according to Reuters. However, we expect financial markets to remain volatile until inflation clearly peaks. Yet an eventual topping out of inflation, even at high levels, is likely to become a welcome sign by both the stock and the bond markets. So high-quality corporate bonds are now offering investors yield or interest rates of nearly 4.5% versus only 1.75% a year ago. The S&P 500's price-to-earnings ratio, or PE ratio, has declined to about 16.5 versus trading at a PE ratio of around 23 in 2021. So although we do recognize that corporate profits and earnings may be revised lower in the second half of this year, we also have to worry about investor sentiment, which has already declined to the very pessimistic levels. They are actually similar to what we experienced during the March 2020 pandemic sell-off, the 2008 Lehman Brothers bankruptcy sell-off, and also the March 2009 financial crisis bottom. Each of these previously events have also created financial market losses. However, when sentiment reaches such negative levels, forward-looking long-term returns for investors have historically improved. So as you'll see on the chart, the S&P 500, despite incurring 5 bear markets in the last 25 years, including the 2 worst bear markets since 1956, which were the 2000 technology crash and the 2008 financial crisis, has produced average annualized returns of around 7.9%. But despite all the market volatility, we have been making some proactive portfolio adjustments to better suit the current market environment. For example, in 2021, we reduced emerging market equity exposure in most investment strategies and continue to maintain limited exposure to the region, which has worked out favorably. So since we began reducing emerging market exposure in August of last year, the emerging market stock index has declined nearly 22% versus the S&P's decline of about 14%. So after producing leading stock market returns over the last decade, growth areas of the stock market, such as consumer discretionary and technology, have led the market lower in 2022. We are observing slowing sales growth, inventory and labor cost pressures at some retailers, and there's also increased competition. We are also starting to see some reduced hiring plans, and several companies have announced layoffs. At the same time, other areas of the markets have been leading, such as the resource and energy sectors, companies with less economic sensitive businesses. This can be companies like tobacco, food, and large cap pharmaceuticals, and companies that pay consistent dividends. A diversified portfolio of dividend stocks can offer investors a dividend yield of around 3 to 4%, with the potential for dividend increases over time. But because dividends have represented about 40% of the stock market's return over the past century, we continue to focus on income as a component of total return and have increased positions in diversified focused equities for some of our investment strategies. We have also held positions that benefit from rising inflation, such as inflation-protected bonds. So we're likely going to continue to see above average market volatility until the markets believe the Fed has inflation under control. So as always, we will closely monitor the situation, make changes based on your financial needs, goals, and risk tolerance as necessary. So if you have any questions in the meantime, please contact your advisor or feel free to give me a call. Thanks for your time.